Welcome to Talk Tickers, your essential summary and focused analysis of the must-hear earnings calls.
Hi there.
Today, we are diving deep into RF Industries. That's ticker RFIL. They're a technology solutions provider.
Right. And their recent fiscal third quarter 2025 results really seem to energize the market. Quite a positive reaction.
Definitely saw that. These results came out after the close on September 11th.
Yep. And look, they represent a pretty decisive beat. So our mission today is really to unpack all that.
Go beyond just the headlines, right? Look at the strategy, the execution.
The margin expansion, which is huge here, and figure out why this report feels like, well, maybe a turning point for the business.
Okay, let's get straight to the numbers then, because analysts were calling this a, quote, clean win, both top and bottom line.
Absolutely. It was a clear financial victory. Non-GAAP EPS, earnings per share, came in strong at 10 cents.
10 cents. And consensus was more like, what, 6 or 7 cents?
Exactly. Cluster between maybe $0.06, 0 and 7s. So, for a small cap company like this, beating by that much, that shows some serious operational control.
And the top line, the revenue, backed that up too.
It did. Came in at $19.8 million. That also beat the street, which was looking for something like $18.5 to $18.9 million.
So not just a tiny beat. And year-over-year growth was pretty healthy.
Yeah, 17.5% increase compared to last year. And up sequentially, too, about 4.7%. Solid momentum.
Okay, revenue beat is good, obviously. But you hinted the real story, maybe the longer-term story, is margins.
I think so, yeah. What's really driving the optimism here is that margin expansion. It really confirms management's hitting their stride on cost control and shifting towards higher value products.
Let's focus on that gross margin figure then. It jumped quite a bit, didn't it?
No, it was huge. Gross margin hit 34%.
34%, wow.
Yeah, and that's a full 4 percentage points above their kind of long-standing target of 30%.
And that wasn't just luck, you're saying. There were reasons for it.
No, not at all. They specifically called out two things. One, selling more of their custom higher margin solutions. And two, just better leverage, spreading their fixed costs over those higher sales. Basic operating leverage, but they're proving it.
Okay, maybe for listeners who don't track this super closely, why is getting to 34% gross margin such a big deal for the investment case?
Well, it's critical because, look, it means for every dollar they sell, 34 cents is left after the direct costs.
Right.
That's the money that covers everything else. R&D, sales, admin, and ultimately generates profit. So a higher margin means each new sale is just fundamentally more profitable. It proves those newer custom products aren't just different, they're actually more valuable to customers.
And you can see that flowing through the rest of the income statement. They're profitable now.
Exactly. That operational leverage is showing up. This is now 4 consecutive quarters of operating profit.
4 straight, okay.
Reported $0.72 million in operating income this quarter. I mean, compare that to a loss in the same period last year. It's a massive turnaround, structurally different.
And adjusted EBITDA. That's another key metric people watch.
Yep, that reached $1.6 million. That's about 8% of net sales.
8%. And their stated goal is what, 10%?
At least 10%, yeah. So hitting 8% now puts that goal really firmly within reach. It's not some distant dream anymore.
Okay, hitting 8% EBITDA on less than $20 million in quarterly revenue.
Huh.
That's what people mean by operating leverage, isn't it? Proving the model works at this scale.
That's exactly it. This is the crucial point, I think. They've sort of reached escape velocity from their cost base.
Meaning their fixed costs are covered now.
Right. They're being absorbed efficiently. So every dollar of revenue they generate above this sort of $20 million level, it's going to be disproportionately profitable. That's the leverage story the market's clearly celebrating.
So this whole shift, they talk about moving from being just a component supplier to a, technology solution provider that requires winning more complex, higher value deals.
Correct.
What are the key markets where they're actually making this happen? Where are they getting traction?
Management pointed to 3 things: diversification, deepening customer relationships, and new partnerships. But for growth, yeah, that diversification into new end markets, that's the most compelling part right now.
So where are they growing outside of their traditional kind of core telecom business?
We're seeing real progress in 3 main areas. First, aerospace.
Aerospace.
They're getting repeat orders there for mission-critical components. Now, this tends to be high reliability work, often with higher average selling prices or ASPs.
Right. Higher ASPs mean better margins generally.
Fewer units, higher price.
Exactly. Second area is transportation. They landed a, quote, meaningful order for a major U.S. airport terminal project.
Oh, interesting.
Plus things like distributed antenna systems, DAS for bus and train hubs,
Yeah.
improving connectivity there.
Huh. So, if you're traveling through a big U.S. airport or maybe on a newer bus line with good signal, you might actually be using RF Industries tech without realizing it.
Quite possibly, yeah. It puts that sort of infrastructure work into perspective. But is there a risk here? I mean, is this reliant on big government infrastructure spending? If that slows down, are these higher ASP products enough on their own?
That's a fair point, and that's why their focus on innovation is also really important. They're developing solutions that aren't just tied to massive government projects.
Okay, like what?
Well, this brings us to their higher value thermal management solution, things like their DD systems, direct air cooling.
EDC. Okay, for listeners maybe not in the thermal space, what is direct air cooling and why is that a significant shift for them?
So DD is basically a very efficient, often customizable way to manage heat in critical spots. Think dense network cabinets or data centers.
Right.
And they specifically mentioned a next-gen DES system they've developed. It has advanced controls, and crucially, it's got NEMA certification.
NEMA-cert.
Yeah.
That's for ruggedness, environmental standards, right?
Yeah. Exactly. Getting NEMA certification is a big deal. It means they can sell these systems into much tougher environments, remote telecom sites, edge data centers, even the energy sector. These are custom solutions, higher price tag, more IP.
Got it. And then there's the venue buildouts piece. That's been a historical strength and often needs customization too.
Absolutely. They seem well positioned for the upcoming cycle. Think Olympics, World Cup. These events need massive connectivity upgrades.
Right. Big events drive spending.
Yeah, and they mentioned a pipeline of over 100 venues. And it's not just sports stadiums, it's also like corporate campuses, university campuses, places where top-notch connectivity is now just expected.
Okay, so the margin story sounds great. Diversification sounds good. But let's talk about the future, the guidance. It was strong, but wasn't there a little wrinkle with the backlog figures that maybe gave some people pause?
There was, yeah, a bit of nuance there. So management guided for Q4 net sales to be pretty similar to Q3's strong result.
Okay, so holding steady at these higher levels.
Right. And they confidently reiterated that 10% adjusted EBITDA goal and said the gross margin should stay durable, at or above 30%. That's strong visibility, suggests confidence.
And bookings look good in Q3 itself.
Very robust, $24.5 million in bookings in Q3.
Yeah.
That resulted in a really healthy backlog of $19.7 million when the quarter ended. Seemed like great momentum heading into Q4.
Okay, but what's the nuance then?
It is, but here's the thing that needs a closer look. While they did a great job working through that backlog, converting it to revenue, the backlog today, or rather when they reported, stood lower at $16.1 million.
Okay, so down from $19.7 million at the end of Q3 to $16 million more recently.
Correct.
So how do you interpret that? Is it good news because they executed so well? Or is it potentially a warning sign for Q4 revenue despite the guidance?
That's the million-dollar question, isn't it? That's the critical tension point.
Yeah.
Management, understandably, framed it as positive, a result of successful, rapid execution on existing orders, shipping product quickly.
Okay.
But investors, quite rightly, will be watching very closely to see how quickly they replenish that backlog in Q4. That bookings engine needs to keep running, bringing in orders well above that $16 million mark if they want to maintain this revenue level into fiscal 26.
So if we don't see strong bookings reported for Q4, that guidance might suddenly look a bit more optimistic.
It could come under pressure, yeah. That backlog replenishment is definitely the metric to watch now.
Okay, let's connect this back to the bigger picture. The market reaction, the stock price jump after the call. That bullishness seems rooted in the idea that they've proven this higher margin model works, even at current revenue levels.
Precisely. It feels less like just a good quarter and more like a structural shift, a replatforming of the business model.
Right.
Their intense focus on profitability, getting that margin sustainably over 30%, and the clear success in winning these higher ASP deals like Aerospace, DTech, cooling it, offers a credible, tangible path to that double-digit EBITDA goal. It's not just aspirational anymore.
So for investors looking ahead, thinking about the next few quarters, what are the key things we need to see? What are the proof points to watch for?
I'd say we need confirmation in 4 key areas. First, the core business needs to hold up. So, continued orders from Tier 1 carriers for things like small cell concealment.
Okay, core stability.
Second, we need to see real evidence that these new growth engines are ramping up. So follow-on orders, expansion in aerospace and data centers, not just one-off wins.
Makes sense. Growth needs to continue.
Third, obviously, that margin durability. Can they consistently deliver gross margins at or above 30%? That proves the shift is real.
And the fourth area, something external, macro.
Yeah, the macro backdrop matters, especially for small caps. We'd want to see continued momentum or at least stability in the broader small cap space, maybe helped by expectations of easing policy, which has been supporting the Russell 2000.
Right. A rising tide helps, even if they're executing well internally.
Exactly. And the company seems aware of external risks like supply chain issues or tariffs. They mention managing that by strategically increasing some inventory levels, focusing on what they can control, efficiency and diversification.
Okay, time now for our weekly segment where we pitch a provocative, maybe slightly outrageous trade idea delivered with perhaps the conviction of a hedge fund analyst. And as always, this is purely for discussion. This is not financial advice.
Right. So given the really strong execution we've just discussed, that impressive 135% return over the trailing year, and this clear pivot to higher value, stickier business.
Sounds like a setup for a bullish call.
It is, but with a twist. We're thinking a highly focused, potentially leveraged bet specifically on the company's own story, that margin expansion, while trying to isolate it from just general small cap market moves.
Okay, isolated how? Lay out the pitch for us. What are the mechanics?
Okay, the pitch. You initiate a long position in RFIL equity itself. You're betting on that post-earnings momentum continuing, betting on management delivering that 10% EBITDA target.
Standard long position. Got it. But the isolation part.
Right, to hedge against the risk that the entire small cap market rolls over, because let's face it, all small caps depend somewhat on general market sentiment on the Russell 2000.
Sure.
You pair that long RFIL position with a small short position in a broad small cap index tracker, like the IWM ETF or Russell 2000 futures.
Ah, okay. So you're creating an execution-focused pair trade, betting specifically on RFIL outperforming the broader small cap index.
That's the rationale, exactly. The bet is that RFIL's successful transformation into this higher value solutions provider, combined with the operating leverage kicking in from those higher margins,
Will allow it to power ahead, even if the general small cap market just treads water or even dips a bit.
Precisely. You're trying to profit specifically from the company's unique execution story, the story validated by this Q3 beat, and that clear path they've laid out towards double-digit profitability, isolating that from just riding a general market wave up or down.
Interesting angle.
Mm-hmm.
Betting on the specific alpha, hedging the beta, so to speak.
You could put it that way, yeah.
All right, that wraps up our deep dive into the RF industry's Q3 FY25 earnings call.
Yeah, I think the bottom line is pretty clear. A definitive beat, really driven by that impressive margin expansion.
And the strategic diversification into these newer, higher value markets seems to be paying off, setting them up, potentially, for a strong finish to their fiscal year.
Indeed. Although, as we discussed, we'll definitely be keeping a close eye on that backlog replenishment. That's the key metric to watch heading into Q4.
Absolutely. Well, thank you for joining us for this deep dive. Remember to send us your ideas for the next topic you want us to tackle.
We'll see you next time.
See you next time on Talk Tickers.